March Madness is coming up. Who do you think it'll be this year, Cinderella? I'm ready for my UVA Cavaliers to make another run at the title, and thanks to YCharts, we can all get our market research done in a snap and spend even more time watching the tourney. With YCharts, it takes less time and effort to analyze securities for due diligence, create visuals that show off your insights, and share your recommendations with clients and prospects. One of their newest features, Scenario Builder, has been a big hit with our team. It lets you pick any portfolio, fund, or stock, then show how different investment scenarios may play out. Think dollar cost averaging, contributions, withdrawals, taking income during retirement. YCharts is an awesome tool for illustrating all these concepts to your clients and prospects, and yes, they include shareholder yield. Even more exciting, YCharts was kind enough to give our listeners free access to their entire platform through March 31st. Click on the link in the show notes at mebfaber.com to sign up early and take advantage. Once again, free access. Use the link in the show notes so you get full access until the end of March. And now back to our show.
Jason, welcome back to the show.
Great to be here. Big fan of the show. And let's get to it. Lots to talk about.
You know, man, I looked it up the other day because I wanted to listen to our old interview. And I was like, how long has it been? And I cannot believe this, but it's literally been 5 years. You were in LA. It was episode 69. And we're closing on like 500 now.
Oh, am I 420 and 69? Wow, what a coincidence.
Well, we'll see what number this is.
Name it 420 just for the heck of it.
Yeah, no matter what. But listeners, definitely go back and listen to the first episode with Jason, because we do a lot of background and lay some foundation talking about angel investing. And we'll get in deep again today, but it's definitely worth a complimentary one to listen. It's really thoughtful, and I think it aged well. We'll touch on some of the stuff today, but first we got to talk about a couple of things. Where do we find you? Are you in the Sierras?
I am at Lake Tahoe, and so I gave some thought over the last couple of years after a friend of mine died, Tony Hsieh, the founder of Zappos, a very close friend of mine, tragically died. And I was like, gosh, he lived such an amazing life. Such a beautiful human being. His book was Delivering Happiness. He tried to make everybody happy and joyful every chance he got, and was really impacted by his death, which came, the day after my 50th birthday during COVID. November 29th was, I think, when they officially said he had died. And, as I was having conversations with some friends, and it turned out I had never really thought about anything that I enjoyed in life, or optimizing my life for my own enjoyment. I've always tried to be of service to my family, my friends, try to be a really good friend, really good father, really good husband, really good investor, board member, collaborator, boss, whatever it is. And I was talking to somebody who says, what do you enjoy? And I like doing my podcast. I like angel investing. Like, yeah, that's for other people as well as yourself. But is there anything you do just purely for yourself? I said, I always like skiing. Great memory skiing with my dad when I was a kid at Hunter Mountain and Wyndham. Then I just said, YOLO, and I bought the best ski in, ski out house I could find with a movie theater in it. Quite an indulgence for a kid from Brooklyn who grew up middle class to own a second home, to even own a primary home to me. But to own a ski house, that ski in, ski out, was a mind-blowing concept for me. And last year I skied 40 days. This year I've skied 16 or 17 so far. And then I'll be going to Niseko in Japan in 2 weeks, or probably at the time you publish this. And I'll doing a speaking gig in Tokyo. But I had on my bucket list, I always wanted to ski in another country, whether it was South America, Europe, Courchevel, Italian Alps, whatever, and Japan specifically. And I got a speaking gig in Tokyo, a low-paying one, not one of my big corporate ones. And I told my speaking bureau and the people who do my speaking stuff internally, anything in Miami, Salt Lake City, or a ski town, or Japan, I'll do. France, whatever. If I get a paid speaking gig, because I had said no to them for a couple of years. And I'm going to Salt Lake next week.
Is this the first time for you to Japan?
First time to Niseko to ski in Japan. I've been to Japan many times. It's one of my favorite places to go. So anyway, long story short, I've been trying to incorporate some things that I enjoy into my life every year now that I've turned 50, I'm in my 50s.
Well, smart. It's thoughtful. Before moving to LA, I was a Tahoe resident, so I lived down in Dollar Point. Different part of my life. I lived with like 5 roommates and worked in Incline Village. But Jason, I just got back from Japan last weekend. I grew up skiing in Colorado, but we have a kind of like an annual ski trip that's been going on for a very long time. It started out mostly in the US, but then to Canada and elsewhere. But you and I can download after this so we don't spend the whole time talking about it. But we've been to Japan skiing probably 5 or 6 times. And I imagine we should talk something about markets eventually on this podcast. But
absolutely. I've become a public market investor now, with my jtrading.com.
I was going to ask you about how many days you got in this year. And all right. So one more rando question before we start. I don't know if you saw this, but I tweeted this to you. There's an annual thing we do every year. We've been doing this for probably 7 years on Twitter. And I was actually writing about a variant today. I was talking about free money in markets. And one of the things I was tweeting out today is to the followers to say, what do you earn on your savings cash balance? And I've done this various years. And the answer is always half the people say either they don't know what they earn on their bank account or it's essentially zero, right? Which is free money because you can get 4% anywhere now, buy an ETF, get 4%, put in T-bills. But there's another one that we've been doing for a long time, which is looking up abandoned assets at state governments, right? So it's in the main website is called unclaimed.org. But we talk to financial advisors to do this. And I say, hey, you can do it for clients. You go to Thanksgiving, talk to your family, look them up. And what happens is people move. They have stock certificates. We found millions and millions of dollars for people. I think the largest is like 250K. We don't take anything. Obviously, we say, hey, go find this. There's nothing people like better than found money and goodwill. But we were demonstrating this other day on Twitter. Say, you don't believe me. I say, who's got a funny name? Calacanis.
Calacanis.
And you know this? You got like 15 grand sitting at the state treasury. You're not going to claim it? You're just going to let it sit there? Jason, come on, man.
I have people in the process of doing this. This has literally been coming up for 2 years. And yeah, I do have 15K. And I think it's from when I was in New York. We had a bank account at one of my businesses and somebody didn't empty it. And yeah, it's, or it was some bill that somebody owed me or something. So yeah, they're trying to find that 15K. And I think I'm getting at Robinhood 5 or 6% on my cash there. And so I was like, whoa, that's compelling because I've been J trading. And if you go to jaytrading.com, I decided, watching you do public market investing and Bill Gurley and other people, I was like, I need to learn as a private market investor. We invest in 50 to 100 startups a year. We tend to build an ownership position of 6 to 10% in them nowadays. We used to be under 1%. And I certainly saw companies I invested in like Uber, Robinhood, Desktop Metal become publicly traded companies. And I started to have a strategy as a portfolio manager of when do I distribute these? And this is a big discussion. Do you let your winners ride, or do you pair your positions? And in some cases, I was selling Uber in the private market for $31 to $36 a share when it was a private company, essentially where it's trading right now, but below its IPO price. I had opportunities to sell Robinhood at $25 a share, more than the price it's trading at now. And so I made some amazingly prescient private market trades. We had Calm.com, a meditation app we're in. We had another SaaS company that hit $1 billion in revenue. And we started selling some of our positions and distributing to our syndicate members and to our fund members, which they're incredibly grateful for. And other people, when I sold them, were like, why are we selling? And so I said, you know what? I have to become, just because of the job I have to start trading public markets to understand equities. And I talk about public equities or just public companies on my podcast all the time, This Week in Startups and All In. And so at J Trading, I have made, I'm up 3%. I started last summer making trades. The S&P is up 1.5% in that time. I was up as high as 10, down as much as 15. But I started buying different stocks based on different theories. So I bought Stitch Fix because I was watching people who were involved in the company buy shares in it. I bought Disney, Amazon, Warner Brothers, Taiwan Semiconductor, Shopify, Robinhood, Uber, Apple, Netflix, and Facebook. But I had a different theory on each, and I talked about it on my podcast just to be accountable. And I found when you're publicly trading, being accountable, saying your thesis on a program, you get back people who are so much more knowledgeable and deep in these names who then tell you you're wrong. And then you get to have this great dialogue. And public market investing is completely different than private market investing because you have so much public data available and you're not allowed to trade on internal private information. Now you look at private companies. All you're trading on is private information, insider information. If you do insider trading, you go to jail for public companies. And in private companies, that's all there is. There are only insiders, and there's only 1 to 100 investors in this company typically. Everything is insider information. Technically, you're sitting with the founders and hearing their vision. They're giving you a deck. They're giving you projections, and you're the only person seeing it, and you're making a private market trade. And so this has been wonderful for me as I look at what's happening in private companies. I'm seeing layoffs there. I'm seeing restructuring. I'm seeing pricing discussions, marketing discussions. And then I'm seeing the same thing happen at Facebook or Apple. So as but one example, Apple made it harder to target users for customer acquisition, right? They started giving people more privacy and not letting you track people. Well, Facebook got hit by that pretty hard. But my startups got hit by that before that was ever public knowledge. I was watching startups tell me, hey, we're trying to acquire customers and our CAC, our customer acquisition cost, is going up. I said, why is that happening? Oh, this personal information is being blocked by Apple. I'm like, tell me more. So all of a sudden you start to see what is happening at a 5 to 50 person company and at a 50,000 to 1 million person company like Amazon. It's been really great for me to sharpen my blade and see what happens when they go public. But you do this too. You did the opposite. You went public to private.
Right. And I think they inform each other. A very personal example, I was laughing as you're talking about this Apple, because listeners, if you try to buy a ticket on StubHub using Apple Pay, it makes your email, you have the choice to be anonymous email, but it jacks up the connection between the ticket brokers and they lose the ticket. And so I was sitting there at a Nuggets game downtown LA, and one person after another came up and said, hey, I got the StubHub ticket, but it's not downloading. It's just like dozens of people. I'm sure they'll fix it, but just don't use an anonymous email if you're Apple Pay and using StubHub. So talk to me a little bit about, this is a topic that I think so many people struggle with. We do a Twitter poll and we ask people, we say, when you buy a security, and most of my followers are going to be public markets, but I said any investment, when you initiate the position, it could be a fund, it could be anything else, but what percentage of the time do you have sort of sale? This is to the Twitter poll. What percentage of the time do you establish sell criteria when you initiate the position? So like, how are you thinking about selling it? And it's like 90%, 95% don't. And the reason I say that is, hey, look, there's the investments that are going to tank or do poorly. And you got to think about how you're going to deal emotionally with, are you going to double down? Are you going to cut your losses? Lots of different schools of thought. But you also have to think about it from the winners. And you have a stock that doubles. Hallelujah. Thinking about skiing in Tahoe. Hey, I'm going to take this money and go to Japan. But every 10 bagger, every 100 bagger was once a 2 or 3 bagger, right? And so a lot of people tend to be very quick to sell their gains. And so I know Sequoia was the big one moving into this kind of like, hey, we're going to maybe hold on to some of these public companies. But how do you think about these winners? Because I've seen both sides of it.
Yeah. So my goal was to become a world-class public market investor. Now, I'm a world-class private market investor. That took me a decade. So I assume this will take a decade as well. So then I said, I want to find companies that are going to be 5 times bigger in 10 years. I just thought that is way bigger than the market grows, right? It doubles every 7 years or so, I guess is the common wisdom. And so rule of 72, et cetera. So I just said 5 times bigger is absurd, right? Like these things are in 10 years will be growing 1.5 times or something. So I'm going to try to find like real outliers. And so that requires a high growth company. I'm not doing this to preserve capital. I'm trying to find 5x winners. So that means you're going to have some risk-taking companies. It can't be consensus companies all the time. And I looked at what was happening during this down market in the third quarter of 2022. And given what I know about companies, I said, these companies are greatly undervalued in many cases, and they have incredible management. And I have a front row seat to how innovative they are. And so I believe in studying products in the early stage. I make the majority of my decision based on the founder, the product, and the customer reaction to that product. Three things: the founder, the product, and the customer. And in an early stage company, they might have 2 customers when we invest. It might have 5 customers when we invest, might have 15, 50, who knows? And they might only be making 5,000 to 50,000 a month. That tends to be our sweet spot for an angel investment, very early stage. In public markets, the management teams are pretty well established. You can garner some data on that. Do they do what they say they're going to do? And then the product is where I start to really look at it. And so when I made my Warner Brothers Discovery trade, and I made my Netflix trade, and I made my Disney trades, looking at those companies, I perceived in each one of them some massive strength on the product front, and then maybe that the overall category would be transformed in a way that people didn't anticipate. So for Netflix, people were in that stock, but it was incredibly low priced historically. But when I saw what they were thinking of doing with advertising and how quickly they were moving, I said, whoa, product velocity. They're moving really fast to add this advertising tier, and they're losing subscribers. And I was like, wait a second, they're losing subscribers. People have given up on the business, but people really want that advertising inventory. And I think that they're one of the 3 possible winners on the road to what I believe will be 1 billion user products. I believe Netflix, Warner Brothers Discovery, and Disney will have, the 3 of them will have 500 million to 1 billion users in the next decade. Those subscription level services have never existed in the history of humanity. The largest subscription services tended to be the telcos, 100 million people for AT&T or Verizon, right? Even AOL, it hit 30, 35 million at the peak paid for dial-up service. But when you watch these companies all of a sudden start to break into 150 million, 250 million subs, I looked at each one. Netflix I bought because they were adding the ad tier and they were doing it quickly. Turns out that was a pretty good bet. I'm up, moderately on that one. Disney, I'm kind of treading water on, but I was watching their innovation with specifically Disney Plus and specifically what they were doing with the Star Wars series and the Marvel series. And I watched those with my daughters, and I was like, the quality level here and what they're doing with Jon Favreau, with The Mandalorian, Obi-Wan, Book of Boba Fett, it was very clear to me, having watched the Clone Wars with my daughters, how much IP there was in Star Wars and how well they were executing on it. I knew about Ahsoka, and then I saw them, they're going to do an Ahsoka series. She's Anakin Skywalker's Padawan. So Anakin Skywalker became Darth Vader. It's Obi-Wan. It was his teacher. And I said, wow, they're going to really crush this if they just execute at a moderate level. And then I was like, and God forbid they figure out how to connect the parks and merchandising to Disney Plus, it's game over. So there is so much lift left for Bob Iger. If they can say, when you're watching The Mandalorian and you get to the end of the series, if it offers you to buy a Star Wars experience at a park at a discount or get your reservation for the new Mandalorian, ride or whatever experience, which they don't have yet, or they got you to buy the Baby Yoda Grogu doll, which they didn't do. And we bought, if I'm being candid, we had bought on Etsy a Grogu Baby Yoda that maybe wasn't exactly licensed properly, but we had to have it for our daughters. And somebody had made a bespoke one. Boom. I was like, that's the winner there. Then I watched Warner Brothers Discovery, and I talked about Zaslav. DC's a mess. He puts James Gunn in charge of DC. James Gunn, who did Guardians of the Galaxy, who's incredibly talented. Great leadership. Then HBO, all the shows that people watch, White Lotus, this new House of the Dragon, the new one. Then you have Succession. You have the new one they're doing, The Last of Us. You have Euphoria. These are must-watch appointment television, which doesn't exist anywhere. So I just looked at the 3 of them. I'm like, there's no way these things are not 2, 3, 4 times bigger in my mind in a decade. I'm going to start building positions in them. And then when they went down, I bought more dollar cost average into them. I want to hold them to see which of those 3 get to $1 billion first. I think those will triple in value, quadruple in value, 5x in value if they get to $1 billion. So, and then in terms of selling, I'm going for the long ball here. So unless management screws up, what I said to myself is, let's look at them on a yearly basis, not just quarterly, but let's look at them on a yearly basis. do they get momentum year after year? And if they don't, I can always sell them and take the losses. But right now I'm feeling pretty good about them.
And by the way, Andor listeners, my wife kind of despises a lot of this sci-fi fantasy shows that I love, but she was like, Andor is the best written show of 2022. She's like, I hate watching these Star Wars, but I love that
And that
show.
one is not like any other Star Wars television I've read. There was no lightsaber in season 1, spoiler alert. It's not about the Jedi. It's about the rebels, and it's about the authoritarian stormtroopers and the emergence of this. It was really an intellectual new take on it. So you say, hey, this IP can be mined forever. And not only that, they can restart the IP anytime they want. So if they want to do the Star Wars movies over again in another 20 years, there's nothing that says they can't recast Luke Skywalker and redo the whole trilogy. In fact, they will. They'll redo all of them. They'll make alternate universes. If those sequels, the last 3, Force Awakens, they were terrible, they could retcon them and take them out of canon and then just start a new one. And that's the power of this IP. They're going to have the X-Men and Fantastic Four, as part of the Marvel Universe since they bought Fox. It was an expensive purchase. But when they put them in there, can you imagine? They're going to get to have, the original Wolverine, the original, X-Men characters, Picard, all those great actors who played them. And then they'll get to flip them over and start them over again with the new young cast. It's going to be the X-Men alone is doubles the cinematic universe. It's going to be extraordinary what Disney's going to be able to do.
There's a great book for the listeners out there who have never been deep in the weeds on distress, debt, and activist investing, like Carl Icahn days. There's a great book about the Marvel sort of bankruptcy and a lot of the agony and ecstasy and just behind the scenes looks into it. We'll put it in the show note links. It's a really fun book.
Comic Wars?
Yeah, I think that might have been it. But
Marvel's Battle for Survival.
Yeah.
How two tycoons battled over Marvel. I can't wait to read that one.
Any of these, like, particularly from the 80s, like these leveraged buyout, world of barbarians at the gate. There's so much intrigue and complications behind these stories. And it's always got big personalities. Anyway, so you're doing this publicly. Part of it is, hey, I want to keep myself honest. Part of it is I want to learn. Has this started to inform your private market aim, like on how you decide to distribute or hold on to these? Is it more just like, hey, talk to us a little bit about that.
Yeah, what I've learned is the public markets are getting priced to perfection, and a lot of the value is captured in the private market. I think you know that. That's probably why you dipped into angel investing and early stage investing, was to see if you could capture that spread, right, between the Series A and the eventual IPO. And so if that's the case, I have now said to my LPs, when we are at 25, 50, 100x on our investment, when we see those moments, we think it's going to be prudent if we have the opportunity, and we're going to become even more maybe proactive in pursuing opportunities as opposed to just reacting from them. So I'm going to try to build that practice of being a little proactive. And I think selling 10, 20, 30% of your position in, 1, 2, or 3 tranches, you could sell 10%, 10%, 10%. Maybe you get a chance to sell 20% and then 10%, whatever it is, to then lock in a series of wins, knowing that these are really high variance bets. That'll allow us to distribute to our LPs, to distribute to our team, keep everybody motivated in the game. And, if we have 70 or 80% or 60%, somewhere in that range, I think 70 is probably the right number. It could be 80, it could be 60. If we have that amount when we distribute from an IPO, that seems about the right number. Because you got to remember, we invested in Uber when it was $4.5, $5 million, Thumbtack, $5 million, Calm.com, $4 million. We're investing extremely early in these companies. And now, we'll invest with like a company like Calm.com. We own 5% of the company. For us to go from 6 or 5 to 4.5, does it really make a difference before it goes public and has an exit? I think we want to lock in those bets. And so, the only regrets I have right now in some of these selling early is that I didn't sell. I don't have many. I'm trying to think of one where I sold and I regretted selling. Like, I don't mind selling Uber at 31, 37, a couple years before the IPO at 45. But then I also like the idea of holding the winners. And so that's where I've wound up.
Yeah, no, I mean, I think your approach is really thoughtful because behaviorally speaking, there is nothing worse as a poker player, right, than building up a big stack and then losing it all. The next day, you're kicking yourself like, oh my God, I shouldn't have played that hand. I shouldn't have done this. And then very real emotional pain lasts for a long time. And this happens so much in investing markets. Is it the necessarily optimal outcome? And we always joke with people because people are always email me, call me, say, hey, Meb, I'm thinking about buying this fund. Should I buy it? Or I'm thinking about selling this fund or this stock. And they're tearing their hair out, gnashing their teeth about it, stressing out. And I say, well, sell half or sell a quarter. And it's going to give you the average of all the possible outcomes. And people hate hearing that because they want the sort of guru certainty, but also they want to cheer for something. They want to look back and say, I was so smart. I told you so. I was right. I sold at the top, or, I got out before it crashed. And so, but that's not probably the most thoughtful way to go about it.
Robinhood is my big example. I had opportunities to sell, and we also were locked up in that one. Unlike some other investments, we have a direct listing. This was a lockup. It wasn't a SPAC. So we didn't have the opportunity to sell those shares for 6 months. And then it's a $10, $12 share when we're distributing, as opposed to a 30 or 40 or 20, or, it had peaked at like 60 when there was some weird stuff that happened in the first couple of days of trading. But, I still believe in the company, and I actually bought some because I think this company is going to be worth more than $8 billion or $9 billion, wherever it's at now, in the coming years. I think it's going to be a $50 stock in the next 5 years. So I think it'll be a 5Xer for me. And so I literally bought it with cash in addition to owning it from when I bought it, for a couple pennies a share as an angel.
Yeah. One of the reasons I like listening to you on Twitter and elsewhere, your podcast, by the way, listeners, 2 good recent Jason podcasts. You had a great one with, I'm blanking on the name, but an Airbnb co-founder.
Joe Gebbia, who people thought he's with a G. Gebbia is how people have pronounced it, but it's actually Gebbia. And he is one of the co-founders. Thank you. He was just on. Amazing guest.
Brad Feld also. We'll put them in the show note links, so take a listen to those. But you're not that old, but some of the older VCs or public market people who have been through a few cycles, usually have the scars or the experience to, in a good way, remember it. And you had a couple good quotes or tweets, I don't know which, but you were talking about cycles, and you talk a lot about it, the good times, the bad times. A lot of people don't. They simply are used to one regime and they get used to it. And there's a really long one for a long time in the US, but you said, fortunes are built during the down market and collected in the up market. People's reputations are made in the bad times, more than the good times. So very similar sort of takes. And talk to us a little bit about how to think through a sort of like full cycle investing in your world, because in no other world does it kind of swing between euphoria, Armageddon, on the operating side as well as the investor side.
Yeah, I've been very lucky to have great mentors. I was a journalist, and then I was an entrepreneur, and then I became an angel investor because Sequoia Capital, my friend Rulof, both started a Scouts program. He gave me some money to invest famously, and I was the first scout along with a guy named Sam Altman. So the two of us had Sequoia companies. He had Looped, I had Mahalo. Neither of those companies worked out particularly well, but we were amazing at placing bets. He actually did a bet on Stripe, and I did Uber and Thumbtack as scouts. And those two are two of the greatest investments in the history of venture capital on a return, because he invested in Stripe in I think the seed round. So it's an amazing, like maybe 2000x or something, depends on when Stripe goes public. Anyway, I got to hang out with Michael Moritz, Doug Leone, Brad Feld, Jerry Colonna, Fred Wilson. I mean, these were the people who, I got lessons from as a journalist, as an entrepreneur, and as a capital allocator. And what I learned is great companies are formed independent of the cycle. And then when the cycle is hot, the prices are high, and the diligence and the time to get to know companies is low. And control provisions and governance gets weak. And so you're paying a very high price for a company. What actually matters is entry price, right? And protective provisions so that you don't get massively diluted. The primary one is pro rata. Do you have the ability to keep investing in a company? Now with Uber and as a scout, we just made a small investment, turned into a huge return, but we didn't have a follow-on strategy for the Sequoia Scouts program. And when I did my first fund, it was a $10 million fund. On paper, I think it's 5 or 6x right now, and I'm raising my fourth fund. So I'm a very elite level. If you were to include my scouts, I am super elite level in terms of returns on paper and distributed. That being said, watching what happened, I was like, wow, I was flummoxed at the difference between when I started investing after the great financial crisis in 2008, 2009, 2010, investing in companies for 5 million and taking our time, and you had a month or two for the round to close. And then the last 5 years, people were throwing money at these companies. And I was looking at companies we had invested in get 50 million or $100 million valuations before they had product market fit. And I was like, hey, can we sell into this? And sometimes the founders were a little offended, but I was like, hey, for our shareholders, this might be a good time for us to give them a little bit of a return. And I passed on investing during that 2021 period and in 2020 on many companies because I said, we're comfortable with our 8%, our 12% position. We're either net sellers or we're going to stand pat. And I had to explain to people the term stand pat. And for founders, they're like, well, we want you, J. Cal, to invest in every round forever. And we said, you know what? At this valuation, we're going to stand pat. It's 100 times revenue. So you have 2 million in revenue, you're getting a $200 million valuation. We're going to stand pat. We're not buying more shares. When the valuation becomes, 10x or 20x top line revenue, okay, yeah, let's talk about it. You have 2 million and you have 20 million. So that's where, my brain unlocked. You have to look at the fundamentals of the deal. And is this going to get a return for your investor? Not just do you love the founder, not just do you love the space or the customers or the product, which my 1.0 angel investor did, but becoming a public market investor and watching some of these come to fruition, I got very much attuned to the concept of, hey, the public markets weigh these stocks, right? It's a weighing mechanism, I guess is the famous quote. And I was like, we're not weighing these things anymore in private market land. These things have nothing to do with gravity. There is no scale. The scale's been thrown out the window. People are momentum investing. And I'm looking at a company saying, wait a second, you're investing in a company with zero revenue and is losing all this money at a $30 billion valuation, a $20 billion valuation. I'm talking about ChatGPT right now. Now, it's a strategic investor. They have different reasons to invest. And I'm not hating on the company. If you can get Microsoft to invest at a high valuation and do a commercial deal with them, Sam Altman is a genius, and he's timing it perfectly. I think he's playing everything. You couldn't do it better than he's doing with ChatGPT. But somebody asked me, would you invest in that round? And I said, of course not. And they said, why not? Do you not believe in ChatGPT or Sam? I said, no, I believe in those. Sam Altman's just a great capital allocator founder. And so I've gotten very disciplined on that. And I'm very proud of the fact that we passed on so many rounds. And we've had to do a little communication with our CEOs and founders because they're like, oh, does that mean you don't love us anymore, Jake Allen? I was like, nope. It means as a capital allocator, as somebody who represents pools of capital, I can't invest in a company where the revenue's flat or sideways or down. You need to come to me with 6 months of up and to the right or on average up and to the right if you want us to increase our position. So we've just gotten very good at communicating that to folks. And I am more excited about this year investing than I have been in 10 years. This, to me, people are coming to me with amazing deals. They've got discipline. And the scale makes sense. Like, you're putting the startup and the business on a scale. You're looking at it going, okay, that checks out with the valuation. Okay, the diligence checked out. We talked to the customers. Meb, I had people who said to me, you cannot talk to the customers during the diligence process. And I said, why not? And they're like, you're not investing enough. I'm like, I'm putting $1 million in. They're like, yeah, well, the lead investor's putting in $4 million. It's a $10 million round. You're putting in only $1 million. And they didn't talk to customers. I'm like, what? They didn't talk to customers? And I'm now going back in our diligence and we're not perfect with diligence. Sometimes, we make mistakes in diligence, but our diligence process as seed stage investors was, I would say, 2, 3, 4x than what I was seeing venture tourists doing Series B and C's at. And I'm like, you're putting in 25 million and I put in 500,000. I did more diligence than you. They're like, well, these people are relying on you doing the diligence. I'm like, that's dangerous because I invested in a $5 million or $15 million company and you invested at 500 million. You need to talk to some customers here. You need to look at the P&L. You need to look at the customer acquisition cost. So, the discipline is back in Silicon Valley. Private market companies are coming back to me. They wanted to I had a company I'll obscurify it into like a profile of, let's say, like 3 or 4 companies recently. They told me in 2022, They're raising an up round. It's going to be 2x what we invested at. Great. So let's just pick 20 million as a number. We invested at 20 million. They say, hey, we're going to get 40. Are you participating or not? I said, yeah, get the term sheet and we'll do our pro rata in all likelihood, or at least we'll offer it to our syndicate members. They said to me, we want you to lead it. I said, no, it's better hygiene. We own 12% of the company. Just picking a random number here. You should get another lead. It's better for you as the founders to price it, because if I price it, I'm pricing it at last year's price. Same price, 20 million. So I said to them that, and they said, no, we're doubling it. I said, great. They come back. They're like, hey, we didn't get a lead. So we want to do a round at the same price. I'm like, get a lead that prices at that, because the market has deteriorated and the performance isn't here. Your revenue has gone down or it's flat. You need to show revenue going up. They're like, well, what would you price it as? I was like, if you get a deal, let's just take the $20 million average. I said, if you got a deal for 15 or 10 and you got somebody to put in 5 million, we would stand pat and we would take the dilution because the company's not growing. So not only am I not going to pay double the price, I'm not going to do the flat round, because that was 6 months ago we had that conversation. The market has deteriorated. You should just close $5 million at any valuation you can get. And we might do a little pro rata or put in a token amount of support. And these were very hard conversations to have with founders. And I watched them go from not believing they weren't worth twice as much to not believing they were worth last year's valuation to then now coming back to me and be like, we'll do a deal at any cost. And it's like, you know what? Investors have their choice of companies right now. You should have taken the money when you had the chance. So
people start to anchor, if anything, the hedonic adjustment of money and numbers and wealth. People always anchor to that new number, and
it's problematic.
It's problematic, particularly when that number,
to use what the millennials say, problematic.
It's not necessarily liquid, right? It's just it's a number up there somewhere. So for the listeners, give us a quick review. I mean, if you listen to our conversation 5 years ago, Jason, it's funny because you're like, what's the future hold? What's things look like? Probably going to do XYZ, this many deals a year, probably for 5 more years. And then, that'll probably be it. And then here we are, you're like, doing more than ever, killing it on a number of different initiatives. Give the listeners an overview of kind of like your syndicate direct to investor offering, as well as your new fund, to the extent you can kind of talk about it and what you're doing there.
Paradoxically, I can talk about it. So when you raise a venture fund, you cannot talk about it. 506B says, hey, you can only invite people you already know. And if you publicly talk about raising a venture fund, you will then reset your, sort of quiet period, just using a term. And, that's why venture capitalists don't talk about their funds. And then people are like, oh, I would have loved to bid in your fund, Jake Al, or whoever. And it's like, yeah, I'll talk to you again in 4 years when we raise the next fund, or 3 years, whatever the pace is. And then there's 506C where you can talk about it. And the difference is when you talk about it publicly, which I have on All In or This Week in Startups, hey, I'm raising our 4th fund, I can meet new people, but then they have to be certified independently that they are, in fact, an accredited investor, or what's called a QP, a qualified purchaser. You can look that up online. Basically says you're a rich person, you've got a lot of resources, a lot of net worth, and you can make decisions to invest in private companies or funds because you're sophisticated in some way. That's how it works here in the United States. So the benefit of doing this is I get to meet new people, which is what I want to do. I can close a $10, $25, $50 million venture fund just by emailing people I know at this point in my career. I wanted to meet a lot of new people. So I said, just emailed our big syndicate list, which is an angel investing club at thesyndicate.com. So when our funds would make an investment, like we did in Calm, we put $50,000 in from our first fund. And then I emailed everybody on our syndicate list, and $328,000 came in from the syndicate. That first fund was a $10 million fund. I was like, okay, 50 basis points in this meditation app, I'll give it a shot. I had no idea that $28,000 would come in from the syndicate, or about that number. But that's 6x what the fund did. So we were doing these small funds, 10 million, 11 million, and then 44 million, 1, 2, and 3. And a multiple, we would put 250 in, and then 750 would come in from the syndicate. So there was more demand, but only half the companies that our fund invested in elected to do a syndicate. So our syndicate represents the half of the deals that we do.
Well, and what was the main reason? Was it because they didn't want information leakage? They just did too much of a hassle? What was?
Oversubscribed is the number one reason. They didn't have the room for it. And number two was they didn't want to go through the process of pitching the syndicate, and it takes 6 weeks to close. And you have now 150 people on your cap table under one LLC. And yes, some people might think leakage of data, although we've never had that happen. Ultimately, what happened was in the non-hot market, everybody was like, yeah, I don't want to do the syndicate. When the market got hot and things were closing, they're like, oh, I don't want to do it. Now, in some cases, the syndicate had pro rata. So we had founders who were like, I'm not going to do the syndicate this time. I'm like, we have pro rata. We have information rights. You don't have a choice here. I don't have a choice. We'll get sued if we don't offer them their pro rata. And they're like, yeah, well, I don't want to do it. So tell them we're not going to do it. I'm like, no, my job is to make sure they get their pro rata. So we had to defend our pro rata, as we call it in the industry, a number of times. And it was uncomfortable in, a small handful of them, but we fought for it. We demanded it. We told new, venture firms that were coming in, because sometimes a new venture firm will come in and say, tell JCal and the other angel investors, they don't get their pro rata, we're not doing our investment. And then in those situations, it happened about 5 times. 5 out of 5 times, those venture firms relented and said, in fact, apologized. And I think 3 or 4 out of the 5, JCal, we want to have a good relationship with you. We're not going to take your pro rata. But they put the founders in a really gnarly position. And this is why public versus private investing is super difficult and different. You have to have a reputation, chutzpah, stature in the industry if you're going to defend that position. And when I was a first-time angel, I didn't. But after a time, do you want to piss off Jason Calacanis? I'm talking myself in the third person, but it's not a good look if I'm an early stage investor and you're a Series B investor and you try to elbow me out of a deal and you try to use the founder as the way to do it. So the founders would be like, I think they're going to pull the term sheet if you take your pro rata. I was like, who's doing it? And they're like, this firm. I'm like, I just had that person on my podcast 6 weeks ago. And I'll call him. And they're like, don't call him. I'm like, of course I'm going to call him. We're shareholders. Don't worry about it. So I have to talk the founder off the ledge. I talk to the person and I tell the person, listen, I know you want to put 10 million and I know you want the whole round. We have 10% of the round. We have $1 million. Do you have a problem with us taking our pro rata? And we also have a board seat option when we own over 10%, which we do. And you're asking them to give up our board seat and to give up our pro rata. Do you want to have an adversarial relationship with me? Because the next time I do a deal, I'll email Ruloff, Chamath, David Sachs, Bill Gurley, and I won't introduce them to you.
Yeah.
Dead silence on the phone.
Yeah.
This is high level, sharp elbowed, private market, conflicted, sparring that occurs that maybe you do have in the public markets. I don't know if there's an equivalent to it, but that's the stuff I have to do. And I think that's what I get paid for, is fighting for the early investors. And so we're raising our 4th fund. I think we had 51 million in demand so far. And I haven't met with institutionals yet. I'm starting the institutional thing after my Japan ski trip and my speaking gig. So in late February, March, I'll start going to institutions. We filled up. Let me take a look here. Hold on. I'll tell you the exact numbers because I literally have a Slack room that tells me Launch Fund 4's allocation requests. And looking at the allocation requests, we had 260 accredited investors for 22 million, 161 qualified purchasers for 29 for a total of 51 million. Now, we already had some other accredited investors, but that's 421 investors in demand. I think we've been able to close about 30 or 40 million of that, somewhere in that range, because, and I don't have the exact numbers here, because you can only have 250 or 10 million in accredited. So accredited investors. So we have maybe 12 or 15 million more in demand than we can accept. So now that all accredited investor slots are open, except for maybe 5 or 10 that I keep for my close friends, like in pocket, we can only accept qualified purchasers now. So I'll start meeting with family offices. People put 250K to 5 million in, and I'll start that process. But it's been wonderful to just be able to say on Twitter or All In or on this podcast, yeah, I'm raising a fund, jason@calacanis.com. Email me if you're interested. And I did 5 webinars with accredited investors, and all this demand came in, and we met all these people, and we were oversubscribed immediately. So this is the democratization of venture capital. That is the next step for me as a fund manager. I did the democratization of syndicates along with Naval and AngelList and Republic and some other folks, and you did some. That's been accomplished. Now there's a bunch of angel investors after I wrote my book Angel and was translated into 11 languages, yada, yada. Now there's all these people who are like, you know what? I've done some private market stuff. Now I want to be in venture. How do I get in a venture fund? And typically you don't is the answer. Big retirement funds, family offices, sovereign wealth funds, they take all the stuff. So I'm going to start meeting with those people. I don't know how I'll do with them, but I don't have to have them anymore. I could just raise a 30, 40, $50 million fund, raise that every 2 years or year or 3 years, whatever it is that we deploy it intelligently, and then just start launch fund 5, launch fund 6 with a wait list. And so I think the democratization of venture capital is the next card to turn over. And for me, having studied the data, and Shamat studies the data, my friend Brad Gerstner studies the data, and we talk about it on All In and This Week in Startups and at our poker game. The vintages of these funds are very important. My vintage as an angel investor was, whoa, with Uber and Thumbtack and Robinhood and Fund One. Amazing. What's the vintage going to look like for 2020, 2021? It's not going to be good. I think the vintages of 2023 to 2026 are going to be like the incredible vintages because the grapes are so delicious, like $5 million, $10 million valuations with 10 customers. Oh, yum, yum. Like if I can get in a company between 5 and 10 million and they already have customers, what I've eliminated is product market fit or basic product market fit. Or are these founders brave enough to release a product and to charge customers? Once you've charged a customer, 0 to 1, not in finishing the product, but in getting a credit card, that as David Sachs has talked about. My friend David, he said, forget about 0 to 1 product market fit, 0 to 1 customer, 0 customers, 1 customers. Getting 1 customer to give you a credit card, that speaks volumes for, the potential of the customer, the company. And so I'm just loving this period of time to your overall question. And the focus level is great. Man, the focus level for founders the last 4 or 5 years, I have so many founders who would be great number 3s, great number 2s, but they got the CEO slot because there's a lot of money sloshing around. And I just thought, this person would be a great CTO or a great head of sales, a great chief marketing officer, evangelist. But are they cut out to be the CEO? Well, based on the performance, no. Maybe they need more years of training. It's almost like the NBA had 300 teams. It went from 30 teams to 300. And you're like, oh, you used to have 2 all-stars per team. Or some teams became super teams with 3. And those were the teams to look out for. Then we had teams with no all-stars. And who is this, ragtag group of people? Now the industry is consolidating back. And you're starting to see 2 or 3 founders start a company as opposed to those 3 founders start 3 companies. And that consolidation of talent is critically important. And so I'm working on that a lot with companies that maybe should shut down, or maybe these 3 companies should merge, create a new cap table. So there's a lot of funkiness going on in the industry right now. But the overall thing people should understand is the fortunes are made in the down market, investing in private market companies. And then the market gets hot and things go public. And as best I can tell, that's when they're collected. And so you just have to have the chutzpah and, the doggedness as a capital allocator to make bets in a down market. And that's why the public market investing has been so great for me. I made those bets in this Q3 and Q4 when people were like, market's going into recession. This is the worst time ever to invest. I think I may have made some good trades. We'll see.
We talked to investors over the last number of years, and I said, look, on the angel side, people getting excited about it, they want to cannonball into the pool and say, look, think of it in terms of vintages and wine or whatnot, and commit to a 5-year process. Because you just put all your money in year 1 over the last few years, there eventually will be a downturn. It's natural. It's normal. It's the creative destruction of financial markets. But if you don't have some money to invest on the other side, you're going to miss a lot of the opportunities.
You got to have some cash around you.
Or said in poker terms, you can never have your stack taken away. Then you can't bet, right? If you're down to 0. We don't need to get into this because we've bemoaned it over the years long enough. The accredited investor rules are stupid, and eventually, hopefully, they'll get replaced. But listeners, email Jason if you're interested in the funds, the syndicate. It's got a lot of information. But one of the things you do really thoughtfully and tell the listeners, because I miss one of them, but there's a number of things. You got Founder University, you got an angel conference, which is what I miss. It's not happening this year.
No, it is happening. We're doing angel We're going to do our Angel Summit in June in Napa, and we'll have a website up shortly. You can email me about it. But yes, it's been 110 people. Launchangelsummit.com, I think, is the last website we had up. It's going to be June 4th, 5th, 6th, and 7th. So everybody arrives on a Sunday. And then Monday, Tuesday, Wednesday, we just talk about Monday and Tuesday are like the main content and event days, kind of modeled after Sun Valley Island and Company's conference, where you do activities in the afternoon and in the morning you meet people and do talks, and then great dinners and late night poker. Then we have something called Founder.University. It's a program where we charge people $500 for a 12-week program if they come to all 12 weeks on Monday night. Thursday is optional. If we take attendance, if they come every Monday, we give them their $500 back at the end. 96% of people complete the course. And then some of them just say, keep the 500 and put it towards the next thing. That's how we meet people really early. And then we have our Launch Accelerator. Launch Accelerator is just like YC or Techstars. We put $100,000 into a company for 6 or 7%. And that's what our fund does. But with Founder University, we said, if anybody gets their product completed and gets a couple of customers and there are 2 or 3 founders and they're builders, let's give them $25,000 for 2.5% of the company and be their friends and family round. And we've done this, I think, 20 times now, where we gave $25K for 2.5% on a simple note. And then we just tell them like, hey, we just want to start a relationship with you. And it's actually really fascinating to be that early. So I was like, wow, we're not making 25K checks anymore, but I want to have a little structure and get to know these people with my team. And I don't scale. So I put 2 of my best people, Kelly and Presh, on running this. And we've now done 3 or 4 of them. 300 or 400 people come to them. And we find 10 to 20 companies at the end of it who, I think we actually have more than 30 of these companies. Of the 300 founders who come, about 100 of them actually build companies that are interesting. And then out of those, we invest in 20 of them. And so that's what our fund will do. Our fund might put 100. We might be doing 100 or 200 of these investments. $2.5 to $5 million worth of the fund might be these 25K checks. What that does is now we have skin in the game. We're on the cap table. We're the first investor in the company. It's super powerful to be the first investor. I was the 3rd or 4th investor in Uber. That was super powerful and made me a legend in Silicon Valley to the point at which people joke about it. And it's kind of a meme that I was the 3rd or 4th investor. I want to be the first investor in like 10 unicorns. And the way to do that is to give them that $25K for 2.5%, $1 million valuation. Take my 25K, incorporate, get a lawyer, and set up your website is basically what we're doing. Then we have our Launch Accelerator, and all of that's done through the fund. And then maybe the fund invests $250K to $1 million, and then the syndicate will do maybe $250 to $1 million. Between those 4 investment opportunities, we hope to get to 15% in our winners. That's our targeted goal. Why is that important? If you have a winner and you're the early stage investor, you know it. You watch it I watched Calm go from 10,000 in total revenue to then have 10,000 paid subscribers at $10 a month to 100,000 to $1 million.
It's like the most magical thing to watch. Like you see some of these, it's so much fun and you feel so.
Which one was the most fun for you and had the best ramp up?
Oh man, let me think about this. I actually looked the other day because my approach is slightly different. I definitely use the JCal playbook when looking through these companies, but it's almost 10 years in. It's over 300 companies. But I was trying, and a lot of these are on paper now, like only 10%-ish, maybe 20% have had some sort of liquidity, bankrupt, IPO. In my wheelhouse is sort of, well, historically, I don't know what you call it today, but sort of seed A. So 5 to 20 million. So in the last 2 years, 5 to 30 million.
You got any 50Xers, any 100Xer yet?
On paper, there's a few. Chipper Cash, which was an African startup, is well into that territory. Jeeves was one that's well into that territory. Gren didn't do so bad out of your group.
Did you get a distribution on it?
Yes.
That's great. Yeah, that was a great one for us. Yeah, Gren was huge.
But a number of these on paper, but I've seen 2 that have gone public that have shown both sides of what we were talking about earlier, where one, they both sold some on the way up. And in both cases, I was kind of furious. I mean, not really. These are small bets for me, but one then, went public and had liquidity, but the other one went down like 95%. So it's like, you see both sides of it where you say, oh God, if it had only been the one that had gone up and then had been like my entire portfolio and then went down 95%, I'd be despondent.
Well, you learn about the power law. And the power law is like nothing else in investing or in society in the world. The concept that an angel investor or a seed investor could get 1,000x an investment, like that doesn't exist in public markets. I don't think in the history of public markets. I'm not talking about 1,000%. We're saying X at the end, or 500x or 100x. When people talk about a huge win in the public markets, they're talking about a 5-bagger or a 10-baggers. In fact, I said I'm going for 5-baggers in 10 years. You have to get very comfortable with 80% of your companies being worth zero. And those companies take a lot of your time. In fact, they'll take the majority of your time just on a percentage basis. And if they're struggling, well, they're going to have 3 or 4 times the amount of questions, problems, conversations. And your reputation is built on the failed companies. With the winning companies, the founders love you forever. Me and Travis and Uber, Robinhood and Vlad and Michael and Alex at Calm. When we see each other, it's high fives and hugs and war stories and awesome. I spend 100 times that effort on the losing company. I have been working on a company that's being recapped and, was worth 20 million and now is worth, in the recap 1 million, maybe 2 million. And I'm still fighting with them to save the founder's equity value, the team's value, and give it another shot. And it's uncomfortable to have a company that was worth 10 million become worth 1 million. But the founders want to keep going. If the founders and the management team want to keep going, and I'm literally I'm going to make this a blended story again, so I don't talk about specific company, but imagine a company worth 15 million, has $3 million invested in it, is now worth 1 million. And then you have to recap the company. So I'm dealing with a bunch of cantankerous, situation and people are not happy. And I said, okay, number one, do we believe in the company and the vision? The answer is yes. Great. Okay. Number 2, does everybody want to work together or fight? Okay. Everybody wants to work together. So I got consensus. I said, okay, here's an idea. We take the 3 million, we make that worth, I'm just going to pick a number, 30% of the company in common shares. Those 3 million people, the people put 3 million in, they have 30% of the company, but it's common. Sorry, you're going to convert. We're going to give the founders of the company, let's say 10%, the management team 30%, and we'll give the new investors 25% of the company for putting but 250K in, and the existing investors who put 3 million can participate pari passu on a percentage basis pro rata in that incredibly juicy financing since the company has tried for a year to get funded and can't. And now the company's still in play if we do this. And okay, I'll put in 50K as a high profile angel to get this started and I'll take some risk or 100K or 150, whatever of the 250. I'm doing that kind of hard work. It's never going to hit my Uber investment, my Robinhood investment, my Calm investment, or Grin investment. It's never going to be worth what Lead IQ is worth, whatever, in all likelihood. But it feels to me like the right thing to do. And if I save that company and let's say it sells for 20 million, well, then those people who put 3 million in doubled their money and they got to save from a zero. And the founders, 5% each or 10% each, whatever it winds up being, the management team, they got $8 million or $16 million distributed. And the new investors, hey, they got a 20x. Mazel tov. Fantastic. We did the right thing. And I'm looking at it saying, this will be a reputation building experience. This founders and this management team and these investors, they're going to love me forever that I took the leadership position here and said, here's how we should do it. And, people think I'm an idiot. I have contemporaries of mine who are like, you're an idiot for wasting your time on this kind of stuff. Just tell them you're happy to sell your shares or shut it down and take the loss. And I was like, nope, I'm happy to fight to the end. And I want to have that reputation.
I mean, it's hard to always look back on it, but, when it feels like the right thing to do, regardless of the effort, like you got to play the long game in financial markets because people, they do remember, right? And one of the things you touched on, and we talked about this on one of your events, can't remember if it was Founder University or whatever, but this concept of power laws, and it certainly exists in private markets. There's some great research that's come out in public markets. Best and Binder listeners will put a bunch of the show note links. We talked about this before about public markets where all the returns come from 5-10% of the securities, the McDonald's, the Walmarts, the Amazons, the Apples. And that's one of the reasons indexing works. And there's another whole area that we talk about, which is trend following, JCal, which you would love to have this whole, as somewhat of a trader now, this managed futures world where this famous trading experiment from the early 1980s involving Richard Dennis and William Eckhart called the Turtles. Have you ever heard about this? It's such a fun story where they were debating, can you train traders? And these were like guys out of the pits of Chicago. And they had a methodology that's essentially letting your winners ride and cutting your losses. So trying to capture the giant multi-baggers, but doing it on, wheat or the Swiss franc or euro dollar or the 30-year US bond, right? So global macro stuff. And it's been one of the most successful trading strategies the last 40 years. It's a little more esoteric, but it's such a fun story because they put an ad in the paper and they trained like 20 traders and they made hundreds of millions of dollars. Some of them who are still investing today. Jerry Parker, one of my favorites, like one of the nicest guys ever from Richmond, Virginia. I think he's now in Florida. Anyway, I'll send you a link later, but some of our old podcasts with Jerry Parker. It's a similar philosophy, different application. So VC public markets, you're trying to find the big winners because a 50, 100x takes care of all the losers, right?
Basically, the power law.
Yeah. It's getting dark in Tahoe.
This is when you know we had a great pod, is when the sun has gone down and my face is super shiny and the last skier goes by. I don't know what that skier is doing because the mountain closes at 4 and it's 4:45. So that person these guys were having hot toddies or something at the top of the mountain and they decided to do a final bomb. Good for them.
There's a place in Austria called St. Anton where they have the big après kind of up the mountain. And so people have to ski down afterwards and like this, 7, 8 p.m. or whatever the time it is in the dark. And it just looks like a little minefield. There'll be like people sleeping over here. Just like, oh my gosh, like you can't walk down. Like there's no way to get down.
I heard there's night skiing in Japan and that's like a thing. They light up the whole mountain. Is that true?
It's true, but it's the last thing you want to do because it's often cold and you are exhausted because you just skied for, 6 hours in the best powder of your life. So I haven't done it.
Do you ski or snowboard?
I do both, but I mostly ski now because I usually have a limited amount of days and it's hard for me.
Did you bring skis with you or did you rent?
I did bring them. Historically with our guides. They used to have all the equipment and we do the kind of combo touring alpine, setup. But, I would definitely, if you could, try to bring your own gear. Niseko will be fine. Niseko, you got plenty of stuff. But if you're going to some of the other places, it's, you'll be happy to have your own stuff and eating ramen and udon for lunch and sushi for dinner. So
I don't have powder skis. I have hybrid skis, Rosignol's, so they're not the really wide ones. I need powder skis, yeah?
I personally would not go over there with anything under 100 underfoot. So I was skiing on some 120 atomic bent Chetlers and they were actually a little long, but I'll send you a video. You definitely, I brought 2 pairs of skis and I only almost
120s are the width or the height?
The width, like right underfoot. So they're high 170s, low 180s, but 120 is the width. So the powder skis, but most kind of mountain cruisers are like 90s, but I don't think I would ski anything under 100 minimum.
Yeah, I got to figure out what my Rosignol's are, but this has been great just for the ski advice for everybody. And anybody has tips for me, Jason at Calacanis.com, my first name at my last name. I'm Jason on Twitter and Instagram. DM me, put my Jason handle.
You can get some locals. I did a tweet. I was like, who wants to do a meetup in Hokkaido? And got some fun responses, but
yeah, I'm excited to do it. Yeah. All right, brother. Well, this has been amazing. Love the pod.
Jason, it's been a blessing. What's the single best place where people can go? They want to get in touch with you. They want to send you a wire with a bunch of investments. They want to follow your Angel University.
Anytime, Jason at Calacanis.com, Calacanis.com. That'll be my email for life because it's my first name, it's my last name, first name at lastname.com. And then I'm Jason on Twitter, DM's open, and Jason on Instagram if you want to see ski pictures from Niseko.
One last question for someone who is a domain acquirer who's been very good. Inside.com, the syndicate.
Syndicate.com, yeah.
You have a good job of acquiring things early. The Tesla early off the ramp.
I serial number 1 of the Model S and number 16 of the Roadster.
I need a Jason estimate. I'm trying to get my last name, so favor.com, from the people who own it. I'm not going to tell you who own it because it might bias your estimate. So it's a one word, but it's a name, and it's not a vernacular word like sofa.com. What do you think is the correct ballpark amount?
5 letters.
I have the .org, but I need the .com.
5-letter .com, 50 to 250.
Okay.
It really depends on if it's common language. And I don't think there's like a Faber common language. I had Jason.com in my sites. I think they wanted $500K for it, $250 for it. I was like, I'll give you $100. I don't need Jason.com. I got Calacanis.com. Yeah. And somebody else bought it, unfortunately, like a crypto person. And so maybe I regret it.
They're in a bear market. That might be coming up for sale soon. So you don't know.
I think it's a developer. Jason Greenwald owns it. Shout out to Jason Greenwald. Good purchase. And I think he's a domainer, and he's obviously very wealthy, and he's an internet guy, and he owns Jason.com. Congratulations. He owns So I don't think I can get it from him.
All right. Well, Jason, thanks so much for joining us today.
My pleasure. If anybody has the most important thing for folks is if you meet a company, they have, $5,000 to $50,000 a month in revenue, $500 a month in revenue, but you think the founder's amazing, the product's excellent. Introduce me to him, or them, I should say, they, them, he, she, whoever, immediately, and don't ask for permission to introduce me to a founder. Just introduce me to the founders. I can take it from there. Jason@Calacanis.com. You do not need to ask permission to introduce me to a great founder.
Perfect, bud. This was a blast.
Thank you, sir. Hope to see you soon.